right, I want to bring on today's guest, Mish Schneider. Mish is the chief strategist at Market Gauge, coming to us from beautiful Santa Fe, New Mexico. Mish, good to see you again. You were actually our first guest in 2024. I feel like a lot's happened since we spoke the last time.
It does feel like a century, doesn't it?
It's a long time ago. So we have a lot to think about, a lot to talk about. But I mean, just before we get into your charts, just at a high level, quite a bit of choppiness. We had, yesterday's session with a bit of a drawdown. Today, a nice recovery. At a high level, like, what are your takeaways from what you've seen so far? Is this time to get nervous, time to be optimistic, somewhere in between? How would you describe your mindset given what's happened?
Well, I feel very bullish. Even with yesterday's big contraction, I felt that there were some key indicators to watch, which I know we're going to talk about. But the fact that there were so many sectors that held up and just fell to support was promising. I don't think the hyper-focus on every word that the Fed utters is necessary. I think basically we can say that even if they keep the rates where they are for longer, that may not necessarily be the worst thing. We've seen it actually be absorbed by a lot of companies. The earnings season was better than expected. And this is apart from the fact that we have, 29% of the SPY has been in the mega cap stocks. I've seen growth in a lot of different areas. I think that's promising. So in case, and even in a little rise in inflation, which isn't unexpected, unless inflation really goes crazy from here, and at this point, barring from a weather or geopolitical situation, I don't see why it would, other than the normal growth of inflation matching an economic expansion. It's possible that this market will continue to go higher, and there's always going to be the wall of worry, and clearly we saw that yesterday. So that's what we're going to talk about, is the signs that we would look for if that changes. But for right now, I'm very comfortable.
Yeah, I always encourage people, don't overreact to one day's information, but certainly it's brought a lot of things into question. I appreciate you setting up some charts to just sort of lay out some of the signals you'll be looking for. We have your chart of small caps to start off. This is the IWM. What strikes you here?
Eliza, she's the little ray of sunshine. Her laugh is full of joy and love. I'm so...
Well, yesterday could have potentially been a disastrous day. So, we have our indicators up there. When we get through a 6-month calendar range, particularly in January, and fail it, that could be considered a key reversal and a top. And clearly, the jury's out on whether or not that has happened. But on the flip side, we broke the 10, but we held the 50-day moving average, which was the encouraging thing. And then with the follow through today, in essence, what we were able to do was fill the gap that it left on yesterday's open. That's also always a positive. So what has to happen from here is, at this point now, if we're truly going to see any kind of rotation into small caps, and even if it's not necessarily rotation the way people classically think it is, but more like small caps finally catch up a little bit to what's been happening in the Qs and the SPY, we have to get through these highs of 202, 203. And if we can't, then the next time we start to turn down and break that 50, I think that would be a warning sign. Yeah. So, and then if we look at the leadership today, it recaptured the SPY in terms of performance. That's another positive. I mean, let's face it, if the small caps do well, that's better for the market generally, and certainly better for the economy. And then, so I like the fact that it's slightly outperforming in that middle graph, the SPY. And then if we look at the bottom graph, which is the real motion indicator, we're back over the 50. Maybe the momentum isn't all that great, but I imagine, as we just said, if we can get through these recent highs that we saw in December, I think then that would be excellent and all around. So this was good. It was positive. It helped, but we need to see a little bit more.
Interesting, and I really love that illustration. Yesterday, the gap lower, bouncing off the 50-day. We'll see if we're able to regain that swing high from the last couple of days. It's a great illustration of just the impact of yesterday's trading. Second chart is looking at the high yield bond market. You've often brought high yield, and I think have spoken well to why this is an important area to look. What's your takeaway here?
Well, yes. First of all, talking about why I'm so obsessed with high yield is it really goes back to 2020. Actually, we're talking almost exactly 4 years ago
Hmm.
when the market started out in 2020 pretty robustly, just like we saw it. Well, actually, the first week in January, if you minus that, we had been robust, except that junk bonds went right to the 6-month calendar range high that year and started to fail. And actually, by the time we got towards the middle or end of February, it started to break down under the 50-day moving average, and then eventually the 6-month calendar range low, and then eventually the 200, and then whammo, that's when we heard the news about COVID. Now,
Hmm.
I'm not saying I expect a COVID-like event, but what it taught me was that this can be an incredible lead indicator. And so that's why I've started looking at it more carefully in the last few weeks, because it got right back up, as you can see there, to the 6-month calendar range high, started to sell off, held the 50, didn't quite get back anywhere, just sort of consolidated, which is fine. It doesn't have to go crazy to the upside or even really sell off to the downside. If it consolidates, that's good enough. It means that things are status quo in terms of investors in high yield debt, companies that are considered basically junk but pay well. And then, of course, yesterday it had that disastrous gap lower, but look where it auspiciously held, which is the 6-month calendar range low. And now today it popped back. So if we put the two evidences together of the fact that the Russells, although they've done better, still really need to get through that 6-month calendar range high to prove themselves, this was sort of dragged up, couldn't get back through the 50. So we want to see a move over 77. We see a move over 77 and the small caps continue up. You've got to really get bullish. And if you haven't been invested in this market, you'll have another chance. On the flip side, if the IWM starts to roll back over under 195 and this starts to break down under that 6-month calendar range low, as you can see here, we have a confirmation of a caution phase. It's well underperforming the SPY. And the momentum, of course, is weakening, but it's not horrible yet. Then I would say, okay, brace yourself, bigger correction coming.
I've mentioned to so many people when I worked at Fidelity, we sat, the charting team sat on the same floor as the high yield debt team, which I absolutely loved because I found that those guys were really laser focused on risk, and high yield bonds would often sort of detect things, right? It would be priced in uncertainty before equities a lot of times would reflect that. So 100% agree on the value of looking at that space. Great take there. Now, how important retail obviously has actually done a little better than other groups here recently. How important is that upside participation in retail here?
Well, considering that consumers 70% of the GDP, I would say it's pretty important, particularly since we still have people calling for recession and we have people terrified of the higher rates, as we just talked about, or higher for longer, as really putting a kibosh on any kind of growth. And you hear all kinds of reports about credit card debt going up, but at the same time, there is money around, and here you are at the consumer. However, just like we saw in IWM or the grandpa, if this is grandma, cleared the 6-month calendar range high, fell yesterday, but not nearly as badly as the IWM did. And now here we are back today at that 6-month calendar range high. So I think this would be another piece of the evidence. If this rolls back over and breaks down under 70, and we saw the other two scenarios we just spelled out also happen, more evidence to be careful. However, if the other two remain robust, or even if they don't necessarily play as well as this does, and Granny XRT continues to get through 73, then we know the consumer's still in the game. And even with the slight elevation of CPI, it didn't really seem to impact the consumer that much. So this is another key area to keep an eye on.
I like that, Mish. I mean, rates being higher, inflation still being an issue, it doesn't feel like the chart of the XRT is feeling those negative implications as much as we might think. I want to get to your last chart because this is an important one. We were talking before we started the show about transports and how much transports have really been leading here today, gapping higher in a pretty big way. What about the leadership in transports? What does that tell you about the environment here?
Well, you know, so now we are really completing what Druckenmiller called the inside sectors of the economy, which would be, of course, the small caps, the retail, and the transportation. And if you think about it, it makes a lot of sense because the small caps are things that are made in America. The retail is how much money people are out there spending. And the transportation is how robustly people and goods are moving. And if you look at today's action, well, first of all, looking at yesterday's action, of course it gapped down, but it didn't really do anything. In 166, if you take your cursor back a little bit to the end of January, look how many highs you had at around 166. No, go the other way. The other way. Yeah, there you go. That whole area of consolidation. Well, I'm sorry, 266.
266, right.
266. 266 was the number. That really was a breakout area once it got through. And then all it did yesterday was break down right back to that support at 266. So now today with this massive gap up, if you take a look at a longer term chart, 282 and change is the all-time high. So everybody's so focused, obviously, on the major movers of the market, not the least of which, of course, is NVIDIA. But meanwhile, this thing is really picking up nicely. So what that tells me again is the economy is in better shape than people like to think. And that if goods and services and people are moving, that is a very healthy sign. And again, means that we've had absorption or somewhat normalization of interest rates where they are. And also people are feeling that the inflation, at least at these levels, is something that everyone can live with. So now you've got it. You've got the whole picture. And no matter what you hear from people, all the fear or maybe the overenthusiasm of people who still think 5,400, it doesn't matter. This really is telling me right now, I'm very comfortable. And of course, as we know, is when things go into momentum, you make a lot more money following the things that are in momentum than trying to find the weaker things that might play catch up. And here you go.
We only have about a minute left, Mish, but I'd just love to ask, we've had a lot of questions recently about some of the leadership names that have just been continuing to push higher, like in NVIDIA. If you're holding a name like this, and are concerned about what the run that it's had. How would you think about a chart like this that's already had such a run? How do you think about how to manage potential downside or to minimize, giving all of that back, which I think is what people are just afraid of, the next big move lower. How do you sort of manage that risk? And how do you think about a name like this that's extended?
Well, this is a classic move that you learn when you're a commodities trader on the floor, especially if you were there when I was, when you had these commodities going absolutely parabolic. Is that you keep a core position. You can have fun adding to the position, but those you want to trade much more shorter term. And the most important thing is that even to the core position, you can take profits at certain tranches and have a wide enough trailing stop to exit that gives you some room for some volatility. Like yesterday, for example, would be a case where you didn't want to get blipped out because you're nervous, but yet not so much room where you feel badly if you wind up giving up 20% of your profit. And that's really the key to successful trading, is really understanding how to catch parabolic moves, not get out too soon, but also take your profits along the way up and feel great about the fact that you've caught one of the rare historical parabolic moves that you'll see in a stock.
That's a great take. And thanks for talking about that idea, the core position, how to sort of trade around it. This was awesome, Mish, as always. Good to see you. Thanks for coming back on the show. Please give our best to Keith and Jeff and the team there at Market Gauge. We'll talk to you again soon, all right?
Happy Valentine's Day.
To you as well, Mish. That's Mish Schneider. She's the chief strategist at Market Gauge, coming to us from Santa Fe, New Mexico. I love that take about, and she offered up, let me lay out these 4 charts that I'm looking at to sort of gauge what's happening here. And I love that approach of thinking of what key levels, what I call a line in the sand, what signals would you need to see that would tell you things are really getting uncomfortable. And until then, the default then is things are holding in there okay. So I think great charts and great take, great investment wisdom there by Mish Schneider at Market Gauge. Folks, we've got